Before we get into the immense value of this video, I thought I'd just plug Invision real quick. We have the Invision 2.0 launch on the 26th of July, featuring a brand new website, improved member experience, such as the ability to hop on a live mastermind call with myself once a month, coaching calls with the team, and a complete Discord revamp. All trades taken are available to see via the pro members. Also an exciting further announcement that we have the Invision Mastery course in development now, which will build on the foundations of Invision technicals, and it will delve into the advanced topics such as traps, lower time frame mastery, and offense defense strategies, among other topics. I'm really excited for this. If you have been on the fence about joining, I would highly suggest joining now. The prices will increase on Friday, so if you do want to join, I would highly suggest securing the original price before Friday. It'll be the first link in the description to join, and I look forward to welcoming you into the group. Now, enough of me rambling, let's get back into the video. Right, this video is going to be very off the cuff, want to speak my mind. I wish I'd had a video like this when I very first started trading 7 years ago now. I'm going to bring it to you. This is my idea of paying this forward. I think it's really beneficial information, and I really believe that this isn't really discussed in the space. You know, when you talk about psychology, it's a very surface layer, but there's so much below that ice. It's basically the iceberg analogy, right? You only see the top 20%. There's so much work that goes on under the shadows, so it's important for me to discuss that. Now, the first thing I want to talk about is something that I never hear talk about in the trading space, which is ultimately one of the biggest keys. When you come into a new period, call it a new year, a new quarter, a new month, your biggest focus should be, how can I build a buffer? How can I set myself up for success? Because that then gives you leverage to then scale your trading. Providing the fact that you have a strategy in place, and providing the fact that you are knocking on the doors of consistency, basically. If you're not at that stage yet, continue learning until you get to that stage, and then come back to this video. However, for those of you who are at that stage, this is key. Put it this way, if you come into a new quarter, for example, Q3 like we're in now, and you start to get a few 2, 3, 4, 5% wins, and even if you get 4, 5% buffer, right, you create a huge advantage for yourself, because now, instead of being in a conservative mindset, you can afford to be a bit more aggressive if you've got the skill set to do that. So let's say you are 3, 4, 5 years in, you understand how to be a bit more aggressive with certain trades. For me, it tends to be in line with daily directional bias, in line with H1 order flow, a few other factors as well. As long as that's in place, I can be more on the offense, but I need to have that buffer in place, because, put it this way, if you've got an 8% buffer for the quarter, and we're in July currently, right? So I use that as an example. You're up 8%, you've got a buffer, and you're absolutely fine. You can afford to be more on the offensive side and take slightly more aggressive trades, still sticking to your trading plan, still sticking to all the rules, but you understand how to use the action on your side to capitalize on the moves. That is the way you use it, because the thing is, if you take one loss, for example, being up 8%, and there's some people watching the camera, put me off. If you're up 8% and you take one loss, you're up 7% for the month. It's not going to make a massive difference. Right then, before I was so rudely interrupted by my microphone dying whilst I was filming that clip, I thought I'd get back to it. So, if you're up 8% profit, you take a 1% loss, you're now at 7% profit, right? Not a huge difference. It's not going to change the dynamic of your trading results. It's not going to change your month. Nothing. If you then take a winning trade, it's 5% profit. It then changes the dynamic of your month, because you go from 8% profit to then 13, 14, 15, and you start to go in that double digit kind of mindset. You build a bit more of a buffer for yourself. You give yourself more room to breathe, essentially. That's the goal with trading. Once you do that, it makes a world of a difference. So your goal should be, how can I put myself in a position where I can afford to be a bit more on the offense and capitalize on more trading results. Essentially what you're doing is you're growing steadily, you're being conservative, and then you get to a certain point results wise, call it 10% profit, call it 20%. You get to that figure, and then you can afford to lean into a bit more aggression because you've got the opportunity to do so, right? But you have to do that original groundwork to get to that point. You can't just be at break even and go, you know what, I fancy being a bit more aggressive because price told me so, or because I fancy it. No, that's being reckless. There's a very key difference between being offensive and being reckless. Being reckless would be, I'm up 8% profit, right, I'm just taking 5 losses on the bounce because I fancied the trade. It was a bit more aggressive, but so be it. That's not the game. That's not how you should be doing things. That is a lack of experience, and that is a newbie mentality. It will come a point in your journey, if you continue going at it and put the hours in, that you get to this point. It's not going to happen overnight. It takes years, I'm not going to lie. But once you get to that point, you understand when to be more on the offense, right? It's almost like your intuition kicks in a little bit more. You understand certain principles. That is the key. But you can't do this too early, because if you try to do this too early, it could end in disaster, which is why, you know, I was a bit hesitant about sharing this, but it will be a point in your journey where it's like, you will know when to apply this. So I'm paying this forward to be like, in 6 months' time, if you're ready to hear this, you're ready, come back to it, apply it. But it will take conscious effort for you to sit down and say, right, within my own trading, what's conservative? What's aggressive? Right, when do I lean in to be more conservative? I.e., when I'm in drawdown or break even, you want to be conservative because you're playing with the balance at that point. To be aggressive, that's when you're playing with the profit. So it gives you a bit more of a buffer. You have more the opportunity to leverage that at that point. You can accelerate the returns because you're at that point in time. But there's a right and wrong way to do it. So that's key. The key is, don't step into that reckless behavior, which just takes experience to know what's reckless, what's offensive. That's the key. Next thing, it's funny how people think trading is a black and white picture. I used to think that too, right? You think, I want 100% mechanical strategy. I want all these mechanics in place. It should be a checklist that I follow. Solid, I take the trade, end of story. Don't have to think about it twice. If you speak to most people in the markets, that's what they're looking for. That's why you see people set up these these things on the side that are automatic and try and replicate trades. It's the same reason. They want something that's mechanical, that they can execute over and over again. Nothing wrong with that, but it's understanding that trading is a skill set, right? So what may be black and white in the beginning, i.e. you follow a checklist, you follow a trading plan, you stick to the rules. As you continue to develop, what you'll notice is that your subconscious starts to take more involvement in your trading without you realizing. You get to a point where your sixth sense starts to become unlocked. This is what Napoleon Hill talks about in Think and Grow Rich. Essentially, it's your intuition, your experience, your subconscious mind getting involved more because you understand how to. You've seen something play out in the markets so many times before, you understand that when it does this, we're likely to see that. Or when it does that, or that's a trade I should avoid, that's a trade I should take. You see these things happen time and time again, and it's stored up here like a filing cabinet, and you need to remember that. The same way that a tennis player, in the beginning as you're learning, you think about the forearm, you think about the backhand, you think about all the technique that's associated with the skill set. But you get to a certain point where, like professionals, what's the difference between a key amateur and a professional? An amateur is always thinking about the technique, they're thinking about where they should put the ball, etc. A pro will step in and just flow with it. They understand rhythms involved, they understand their subconscious will naturally take over. It's the same thing in the markets. So once you reach that level, the only thing that I will say is don't try and battle it. Just let it come. Recognize it, accept it, but don't try and battle it. Don't try and say, I can't have my subconscious involved because the strategy is mechanical. Yes, the mechanics are key. You need to have the same entry model, the same entry types. The fundamentals need to be in place. But once they're in place, you can afford to execute that little bit of gray area as you continue to develop. But once again, similar to the first concept, there's a right time and a place to do this. This next one's a fascinating one, which is to normalize winning. Now, if you're not consistent yet, and you haven't been consistent in your trading journey, every time you get a winning month, a winning quarter, a winning trade, you're probably going to want to recognize that. You're going to want to recognize it. Right, what did I do well in that month that made it a good month? What patterns did I have within my own behavior? How did I stick to my trading plan? All these kind of things you want to dive into taste it, know what it feels like so that you can repeat it the same thing again. But you get to a certain point where you've been consistent for a long time, you're, I guess, successful to a certain degree. You don't need to recognize winning in the same way. It becomes a part of the job. You should be normalizing it. It should be the minimum benchmark. It should be a hygiene standard for yourself to accept. I just win. I'm just a winning trader. I win the majority of the time, or a good percentage of the time. It's a standard for yourself. It's like there was an interview with Kobe Bryant years ago, and someone asked him in that interview, like, why aren't you happy? You've just won a match. And he's like, we're still in the tournament. Job done. He's like, job's not finished. Job's not done.
You're up 2-0. What's the story? Are you not happy, or you're only half happy, or?
Still to be happy about.
You're up 2-0.
Job's not finished. Job finished? I don't think so.
Okay.
He expects himself to win. It's the same thing in the markets. You've got to be able to set that benchmark to say, I expect myself to perform well. I expect myself to perform well for the majority of the time. This is my benchmark. We do not drop below that. It's almost like you have the inchworm theory. You have your A game, your B game, and your C game. As your A game, i.e. your skill set, continues to rise and push into new levels, there's going to be a huge fluctuation between your A and your C game. Because if your C game stays the same, if you're up 20% in results and your C game is down here at -5, the potential of drawdown there is huge. So that's a huge impact on your results, on your psychology. There's a big fluctuation there. So as your A game continues to improve, it's important that you naturally bring up your C game alongside that to minimize the damage, right? To minimize the fluctuation. Essentially what we're trying to create is that steady equity curve in all aspects of trading. So you want to be essentially understanding where your benchmark is, call it -5. You put things in place such as a recovery strategy so that, right, if you take 3 losses in a row now, you then minimize the risk to cap the drawdown. So many principles that you can apply, right? I talk about this in Invision all the time. You're moving your C game up in a combination with your A game. So it's constantly rising. You're constantly getting to new levels. But the problem is, as people get better A games, their C game stays down here and their benchmark stays the same. Therefore, they're going to have these big, wild fluctuations in results, and it's just going to look like a big graph, and what equates to typically the boom and bust traders, right? So it's important to do that. Recognize winning, but then it should be a standard part of the job. It should be something you expect of yourself. You shouldn't be dropping below that. If you ever get to that benchmark where you're on -5, notice how you feel uncomfortable in the moment, but you figure out a way how to get beyond that. It's almost like you have a big bounce away from that. So notice this in your own behavior. If you ever get to -5 drawdown or whatever your benchmark is, notice how you bounce back very aggressively. Same thing on the opposite. If you hit a ceiling of plus 20% or 5 winning trades in a row, notice how you give some of the profit back to the market. Notice how you take a couple reckless trades here and there. It's interesting how we have that floor, the benchmark, and it's interesting how we have that ceiling. So as we're consistently improving, it's important to consistently elevate that ceiling, that mental ceiling, and consistently elevate that floor, that benchmark, which is not easy to do. And there's certain principles to apply with that. But the best thing is, in your mind, you've got to be thinking, right, as soon as I get to plus 20%, call that your ceiling, you've got to be almost uncomfortable with that to a degree that you don't settle. Because when you start to settle, when you start to become comfortable with where you're at, that's when results start to go and you start to go back to break even. That's why you see traders who are up +5 always seem to be at the break even area, right? They can never get beyond that. It's because their ceiling caps them and they don't know how to break through that. It's just all a mental game. When people say trading's a mental game, they always think, right, I've got to get over FOMO and all these emotions, and it's very simple. The truth is, there's just so much involved in the mindset game of trading that people wouldn't even shed a light on. There's so much shadow work and inner work, and self-limitations and self-sabotage work and all this kind of stuff to dig into. And it's just crazy to me how people think that trading's a black and white picture, and it's just honestly not. It's worth it. It's worth it as you continue to progress, but it's definitely not a black and white picture. It's definitely not easy. So, yeah. I think that's the main things I wanted to cover. Don't think there's anything else. A quote to leave you with. We do not become the highest versions of ourselves that we can imagine. We become the lowest versions of ourselves that we can accept.